Good morning. Apologies for being a little bit late there. We just have to turn the lights on and get everything looking ship-shape in this place. Good morning. How are we all?
We had to stick 20p in the meter. They'd forgotten to do it.
Exactly, yeah. Yeah, no one's had their coffee yet this morning, so good morning.
Right.
Welcome.
Come on, Trade Live with IG. It is the 25th of November. What a rally yesterday, Luke Moore, at last.
Finally, yeah.
We were given the relief.
Yeah, exactly, yeah. We should get T-shirts. I survived the great bear market of Monday to Thursday, in the middle of November. Yeah, quite impressive, really. Quite impressive. Seemingly all just on... it was a bit delayed. Were you not surprised that it didn't move more on Friday? Given
not with nervousness over the weekend. You couldn't take a position over the weekend.
Well, it was more Fed speak yesterday that seemingly pushed the markets higher. They started talking on Friday. They've continued to talk overnight, and yeah, we seem to be a bit higher. Bitcoin seems to be stabilizing. Tech stocks seem to be winning. I mean, Alphabet.
Well, for me, yeah, that's what it was. It was Google just absolutely pulling out the bag there. Because I think I might have had the trade of my year yesterday.
Go on.
I was watching CNBC and they were obviously Kramer was talking about Alphabet, and he just a throwaway comment. He said, "Oh, this is obviously great for Broadcom as well." And I thought Broadcom's only up 2, and it's obviously suffered with the rest.
Yeah.
So I managed to get in 100 shares up 2%,
and then it's closed up 12.
It moved. It closed up about 9, I think, but it's gone another 3 since.
Yeah.
And it saved me because, of course, I'm short Alphabet calls.
But don't forget, this wasn't just so the Meta news came out overnight, which was more interesting, and I think that's what really pushed Broadcom with it.
Well, that's the additional 3%.
Yeah.
After the close. Yeah.
Exactly. Yeah.
But it put the booster rockets under. Palantir had a good day. You also had
Tesla was all right. Tesla was okay.
Marvell that we watched up 7.5. So it was the day that was needed after so much pressure on Thursday.
Yeah.
But it's not there for Nvidia or Oracle.
No, well, of course, it was actively a bad story for Nvidia yesterday. The Meta story. So should we talk about that?
Overnight, but let's make sure everybody knows it's not yesterday, the Meta news.
The Meta news came out overnight.
Yeah, so today. So today's news is the Nvidia Meta news.
Yes, it came out like 9:30.
Yeah, that's what I'm saying. So it's not in the market price already.
Yeah?
You said yesterday's news about Meta.
Yes.
But it's not in the market yet because it was after the market closed.
But we've got 24-hour markets on Meta. Of course you can see it.
Yes, but that's not where most of the volume trades, right?
Right.
So Meta will be down today. It shows up Meta will be up today.
Yes.
Nvidia will be down today.
Yes. Yeah, we're showing Nvidia completely flat. 178.89, completely flat. Meta up 3.
No, but it's not flat. That's what I'm saying. It's down today.
Because of the resets.
Yes. So all these numbers are not today's prices.
Yes, but it was yesterday's news.
It was overnight news, and Nvidia will be down this morning.
Shall we see what's coming up on today's show, and then we'll start to pick apart the differences between time and everything that we need to know. I will be here through with you until 8:15, and Joachim Clement will be here discussing the Expert Edge with Angeline from 8:15. And then Mr. Graham Dixon's coming in. Is he coming into the show, or is he dialing in?
He is coming in. He's in the studio.
Lovely.
Yeah, so that will be nice.
I'll have to make sure I come back and say hello to Mr. Dixon. He'll be in, and then we've got a budget special with Neville Hill.
That's right. So Neville was my chief economist over at Credit Suisse. We went through the Greek debacle together, the first Euro crisis, and now Neville set up his own macroeconomics business and also looking at climate change as well. So he is coming in, and we're going to be talking about that budget. All got it lined up for you, of course, with a bit of news overnight.
For tomorrow.
Yes.
We're going to have we need like a lighting special for tomorrow, don't we? Roll it back to Halloween.
Better than this morning's.
Roll it back to Halloween lighting and see how we go. I want to show you something. No, I'm not going to show you something yet. What should we do? Overnight action? Go to overnight action.
I still can't believe we still have that music.
Still.
Yeah. Like, how have we not managed to change in a year and a half?
But we can spin up guess the chart stories like that.
Yeah, exactly. We got a full top 40 of guess the chart songs, but we've got that rubbish that producer Fred made.
Yeah. Oi, whoa, fighting talk.
It's terrible.
Producer Fred ran so we could walk, or no, walked so we could run. Come on, he did the digging so that we could get this beautiful studio for us. Right, so look, let's talk about this story. Meta, of course, have done a deal with Google to discuss their TPUs, thus being one of the first major hyperscalers to prefer Google's TPU chips as opposed to NVIDIA's chips. Now, they're not the first person to use the TPUs.
Yeah.
Because Google have been renting out space, but they're very much keeping them in their own data centers and then saying, hey, come and be a Google Cloud customer.
So look, go on, let's see the article and let's see how much is
So, yeah, here we go.
Exacerbated.
So for years, Google has limited its custom tensor processing units to its own cloud, renting them out to companies, as I just mentioned. But this is the first time that Meta are going to deploy the chips within their own. I look at the state of all my ads over here. Let me just zoom in so we don't get that one. So this is the first time they're going to be using the TPUs in Meta's own data centers, starting in 2027. So it's the first time they've actually gone out and said, hey, look, we've got this hardware for sale now. Come and buy them off, come and buy it off us. And so, yeah, Google, as it says here, rose 2.1% on the after hours, and NVIDIA came down 1.8%. This is the interesting piece. If the deal proceeds, it'll be a significant validation for their own hardware ambitions.
So if the deal proceeds, that's the important part, right?
Yeah, correct. Now,
because obviously,
I want to show you.
Meta, huge customer of NVIDIA. So you buy 85% of your chips from NVIDIA and you buy, 5% from these guys. Does that move the numbers at the margin? I'm not sure.
I think it probably does. Everybody knows that NVIDIA's margins, you have to pay like a 70 to 75% markup in order to get their silicon.
Well, that's why I'm wondering if they're having the conversation in the first place. Of course, it's the art of the deal, right?
Yeah. Now, I tell you what. Let me show you this because this is a little bit of fun. Did you catch the Google Gemini update over the weekend?
Oof. Yeah, it's incredible, isn't it?
Yeah. So their big image editing software is built into Gemini, and what I was trying to find a use case for it, and this seems to be the use case that everyone's going a little bit nuts for. So everybody likes making an infographic, right? But there's a theme going on for teachers that are using it to create an infographic that makes it look as if someone has drawn it on a whiteboard for you. And that's entirely spun up out of
really smart.
Pretty much the same article.
Can we have a little...
Yeah, let's zoom in for you. So I wanted to find out because I imagine most people's first question is, what's the difference between a TPU and a GPU? And so the point that we're making here is that GPUs are a fantastic tool for lots of different things. They're currently being applied to AI. Now, back in, I think it was 7 or 8 years ago, Google realized that this is where the shift was going to go, and so they decided to make their own silicon specifically for AI. So, this is where the Formula One race car comes in as opposed to your all-purpose SUV. So the Formula One race car is specifically designed for math and specifically designed to work on Google's cloud. Whereas NVIDIA's chips, well, they were gaming chips originally, right? And they're obviously being tailored towards AI and processing. But they are not designed, or they are probably designed now, for AI. So it says here, you've got if you want to have a coffee, you use a coffee machine, right? Whereas if you want, NVIDIA is currently a smoothie. You can do lots of different things with smoothies. It's not necessarily the best at one specific thing, but you can do lots of different things with it.
Okay.
And that's the point here. So it's a specialized tool. And another kind of another thing that they've suggested is you've got the GPU, which is the Swiss Army knife, as opposed to your specialized wrench for your race car. So everything that I've read, TPUs seem to be much, much more power efficient because they're much more specialized at what they do. And so Google's bet is that they're going to commercialize these chips and this silicon by way of saying, hey, look, the new constraint is power. We all know that, right? You've seen the US government have actually spun up a piece called the Genesis mission overnight from the Department of Energy that might be worth having a little look at. That's all around how to power and use the Department of Energy and everything that comes with it, because they know that power is going to be the constraining factor. TPUs can do it way more energy efficiently. And so that's the moat that Google are coming after NVIDIA to say, hey, look, you don't have to pay the 75% markup to go and be an NVIDIA customer and the huge amount of power that they need. We've got these chips that are much more specialized.
So is it different customers then? So you use them for different things, it sounds like?
No, they're the same customers. But at the moment, instead of having the Henry Ford, hey, look, you can have any color as long as it's black kind of style that NVIDIA have been producing, the old Model T, now it's like, what are you going to use your car for? We will sell you a chip that's going to be specific to your use case because it's much more specialized.
Right, but so is it the same? Can it do the same thing though?
Yes, but you'd argue that the TPU can do it quicker,
yeah,
and way more energy efficiently.
But if you want more general things, then you go with NVIDIA.
Well, no, not necessarily. Generally, in the sense of,
it's just the espresso thing's got me. Like, I don't go to a smoothie maker for an espresso.
Yes, yeah. Well, I think the Formula One car and the SUV is probably a bit of a better analogy. You know, the SUV can take you up a mountain, it can take you through rivers, it can take you wherever.
Well, that's what I mean.
Formula One cars are going to get you straight line as quickly as you can get there.
Yeah,
I think is the way to think about it. But Meta backing into Google as opposed to NVIDIA is really interesting. But
or in talks to,
of course.
Yeah.
But also Gemini 3, so this most recent model that Google have produced, entirely trained on TPUs. It's the first
on their own ones.
On their own ones.
Yeah.
So it's the first big model that hasn't been trained on NVIDIA's silicon.
Altman's going to be sweating, isn't he?
He'll be spewing. Yeah, completely. Yeah, it's interesting. It's really interesting. But Google, what an absolute.
But it's, it is just this one article, right, that has got it moving, right, from sources.
Specifically this order pushed it up. I mean, it was breaking out above $300 anyway. And this is really kind of.
Yeah, but we're saying, is there an actual confirmed order there from Meta to Google?
No, it was reported in the information overnight.
Yeah, so it's reported.
Yes, yeah, reported. Yeah,
and that's the same publication that said that Oracle was making negative margins on NVIDIA chips as well. So they are gunning for NVIDIA.
Good point. Yeah, good point. I mean, Oracle,
they want to be the one that breaks the story that causes NVIDIA to go down 20%, right?
Well, they've obviously backed Oracle, which has been an absolute shower of ever since that news came out about their deal with OpenAI. Of course, we spoke about that last week. Yeah, but that's one of the biggest stories overnight, the one that I could see at least.
Right, NVIDIA also, front page of the Times, have invested in Revolut, random. So they've now given the Revolut a $75 billion valuation. That allowed the staff to get out more, get out of more of their positions. So they'll be happy with that one.
How's our IPO market looking on it this morning?
Hasn't really moved.
Interesting.
It was the first thing I went to, and it's still, what is it, 114, 120?
Let's have a little look. So what's that saying? That's a $75 billion valuation.
Yeah.
And we are
120.
We're 120. Yeah, 120 offered.
So that would be quite a markup from last deal.
It would be. What's that? 75 plays 120. Yeah, that's a big markup.
Yeah.
I still think one of these. Revolut bigger than Barclays Bank now.
Yeah.
That doesn't seem right to me. Is it?
Is it a buy Barclays? Yeah.
Yeah, it could be. Yeah, I mean, what's the market cap on Barclays these days? Barclays market cap is 55. It destroys it.
Wow, that's incredible. Jeez, and that's after a proper rally as well.
Yeah.
Right, what else have we got in the Times then? What was behind BHP's second bid for Anglo? They don't really have an answer in this, to be honest. They just say that they're clearly desperate for copper, and it would cost too much to build it. So nothing new there, but there is quite a few comments just saying, look, clearly you've got a lot of interest still in this deal before the 9th of December. And Chris Lefebvre, an old analyst of mine from Jefferies, really great guy, knows his stuff, been around a long time. He's saying he wouldn't be surprised if all 4 of the big boys are looking at either Anglo or tech.
Really?
Still.
Tech, okay, yeah, wow, okay.
So obviously BHP have ruled themselves out, but do they come along and buy the whole thing?
Well, there was some coverage overnight on copper, actually. Bloomberg was running with a piece talking about the supply issues, stating that US exchange-tracked warehouses have hit a record high of stockpiles of copper. So they've had 9 consecutive months of inflows into these warehouses, with what they suggest is tons are being drawn away from the LME ahead of any potential tariffs that may come, because of course copper's been carved out of tariffs to date. But they're concerned about that. So yeah, they are very much worried about the supply side.
Not Rachel Reeves.
Not yet. No, I don't think the market for copper particularly cares about Rachel Reeves. But they're saying that they think, and one of the pieces that they ran with is that the copper spot market, which is currently trading at 10,850, could challenge $11,000 per ton, which will be the record that it set last month. And they think there may be some momentum into the year end.
Yeah.
So yeah, copper momentum seems to be building.
That's the 2 things I'm looking to buy today for the old ISA are copper, the underlying, and then the European defence names in this Wisdom Tree ETF, because, you know, I would imagine today the names will come under more pressure.
Because of the peace plan, supposedly.
Sounds like we're close, doesn't it?
Yeah, supposedly. Although it doesn't sound like Ukraine have been invited to the party yet to actually.
Yeah, they're in Qatar.
Oh, are they?
Yeah.
Interesting.
Yeah, so Russian and Ukraine are in Qatar today with the Americans.
Cool.
Back channels, of course, not Zelensky.
Of course. And yes, I mean, and the other thing as well, just on a macro headwind, we had Trump speaking to Xi yesterday on the phone, which certainly kind of got yesterday out the gates, didn't it?
Yeah.
You know, the story that they were having a phone call dropped like the second as the US stock market opened. And I sent a text out because I was like, I'm not sure whether this is in the news, I'm not sure whether it isn't, but FYI, and yeah, straight, it just completely kind of took off.
Right, Andrew McKelvey, we'll get on to EasyJet in a second. It does look like an EasyJet mug, doesn't it? It's that exact colour. But finally, in the Times, we got Games Workshop is the Tempest. So is it worth buying shares? Let's save you the trouble to look through all the details and come to the conclusion. It is a buy still, they think. The potential rewards outweigh the risks. And yeah, it's just an incredible company that I have never traded in my life.
I know. It's just throwing off cash. It's I don't know what it is, but it is so impressively strong.
Yeah.
Isn't it one of the best performing IPOs in London ever in terms of growth and cash flow and everything that comes with it? It's quite impressive. I just remember, I think I've told the story before, I spent an entire summer with my cousin when I was a kid. You know, we took an old door that my dad didn't need anymore, and we, with paper mache and spray paint and moss that we went to the shop, built this whole thing. Neither of us could, none of us knew how to play the actual game.
Mate, you could have started this company after that.
God, well, we went to Games Workshop. It was when I was doing my kind of first part-time job working at John Lewis in the Blue Water just around in Kent. The Games Workshop is just like a hop, skip and a jump, and so I'd pop in there before my shift to see what the new stuff was. But this was back when I was a little gaming nerd playing Halo at the weekends.
I think I was the same with train sets. That I was Hornby's version of that.
Nice.
Just used to absolutely love the steam trains in all those shops.
Nice.
Now talking about transport and then geeking out, planes were another one, but EasyJet, with 100 planes in the UK, thinking about starting at Heathrow. That came out of today's numbers, but also the bit more positivity around that target for full year 30. So passenger revenue was above 6 billion, so that is up 9%. The EBIT was 703 million, and just reassuring numbers on the EasyJet holidays, especially. They're 81% booked for next quarter already, and then 26% of bookings for the springtime. And yeah, sounds decent.
Yeah, I've got an early call on those.
Down 5.
Up 2.
Kit.
Early call up 2. But what else have we seen? We've also had Domino's Pizza. Their CEO is stepping down with immediate effect. What else do we have here?
That chart is the FTSE 250, isn't it? And it gives you a glimpse of how much is dependent on tomorrow. If she pulls it off tomorrow, then names like this, right? It has a 2% move today, but then it's got another 4 after that, another 5 after that. Because you can't buy EasyJet today when you've got a massive budget tomorrow.
You can't really buy any of these super UK specific names today.
No.
Because you just don't know which way it's going to go. I mean, we know that personal finance is going to have some question marks. We've already seen the FT running with a story overnight, or kind of late yesterday afternoon, that they're cutting the cash ISA allowance to 12,000.
Yeah.
How much of a story that is, I'm not sure, because most, including our own cash ISA, you can get paid interest within a stocks and shares ISA. So
I think this is the leak now. It's going to be 12,000.
Yeah, you think it is?
Yeah.
So you know, but then it's going to be. Look at the adverts you're getting. Patek Philippe, is it?
I did wonder because I said that to somebody yesterday. I mentioned Patek Philippe, and that's it now on my.
Now it's everything. Well, at least it's not blooming whatever.
Yeah, the old man. Yeah, age UK.
Age UK, yeah. Or when I got hit with protein shakes. Yeah, I mean, the thing in here, it's going to be the story that they leaked yesterday was on the mansion tax for homes above, I think it was £2 million in value.
Yeah, here, about time.
Which was surprisingly concentrated around Kensington and Mayfair and all those places.
Yeah, exactly.
And I think, you know, that's probably a slightly more palatable one.
But it's going to come through council tax, which means that it's the renters that end up paying.
No way. Is that what they're going to do?
Yeah.
But also, I imagine with these things, they're very hard to implement, right? Because you can't liquidate value out of your house particularly easy. If you've inherited a house and you've been in the house forever.
So you don't have to pay it until you either die or move house, whichever comes first.
Oh, good. Okay.
So
no one's going to move, and you just pray that the government flips its stance before you pop your clogs.
Well,
you should be all right.
Even the Tories wouldn't give you that back, would they? They wouldn't go, "Oh, just forget about.
Don't worry about you guys.
Forget about that $500 million that we can take."
What else have we got? Yeah, the cap on the amount that people can put into their pension pots without including national insurance. That seems like an odd one. You know.
Yeah, well, that's an easy one.
It's an easy one because you're taxing the business that's putting them in, really, aren't you? You know, it doesn't necessarily affect individuals.
Yeah. And then, yeah, increase in gambling taxes, obviously, that looks like it's going to happen, especially online. Alcohol and tobacco. And then, so all this sort of bad stuff is trickling out beforehand.
Which is what we said a couple of weeks ago, didn't we? We said a couple of weeks ago they're going to borrow the Trump mantra because it's worked previously. It's talk tough, right?
Yeah.
Leak some really horrible stories over the last couple of weeks and then deliver something that is a lot more palatable. Mm-hmm. So everyone goes, "Oh, great! We're only cutting these allowances here. Fantastic, thanks. It could have been a lot worse." Did you see the story as well? The FT tweeted, and I think it may be on their. Let me have a look, see if it's on the website, where Reeves has come out and said to the banks. Here we go. Reeves asks the banks to praise her plans because they've escaped a tax raid.
Little bit of artistic journalism there.
There's a fantastic Twitter account called Polemic Pain, Paine. I follow, and it was actually one of Beachy's recommendations. And he said this morning, it was like, the government tell us that they never negotiate with terrorists. Yet here they are, basically holding a gun to the head of the financial services sector, saying, "Look, we're changing everything, and it's going to get worse. Back us."
It's quite
nicely
smart the way that they've said, right, we're going to tax the banks. And the banks go, no, don't tax us. And they go, "You're going to talk about us nicely after the budget?"
Yeah.
Yeah, you're going to do that? Okay, we won't tax you then. Smart.
Can I do that? Oh, we need to stop calling you Rachel from accounts, and then we'll all be given let off.
Yeah.
Yeah.
Right. How's that right? Domino's CEO gone.
Yes. Yeah. I said that. Yep. So Domino's CEO early calls down 1%, not a huge amount.
Did he fail to deliver?
Hey. What else do we get here? Next have liquidated a piece of land that they're not using. £45 million going to Next.
Right. On that huge headline.
No.
But
it means
take
they're
a quick 2-minute break
to generate an exceptional profit of 16.3 million, and they're going to pay a special dividend of 45p as a result.
Yeah, it's decent.
Decent. Cash.
We'll see you in 2 minutes for the market open. Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris CJ Fellingham, every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. Every Monday I break down a carefully selected trade setup live in my Trade of the Week. Whether you're new to trading or have years of experience, Trade of the Week will help you to generate powerful trade ideas and execute them with precision using stop losses and profit targets. So if you're looking to enhance your skills and boost your confidence in the markets, join me every Monday for my Trade of the Week live on Trade Live with IG.
Welcome back to the opening bell on this Tuesday, the 25th of November. One story we didn't get through
was how much you ruined Axel for yesterday. What did you do to the poor guy at the Arsenal match?
Axel, bless him. He put his Trade of the Week on. I haven't seen it yet.
He struggled through his Trade of the Week.
Well, not every day. So I took him with me to the football on Sunday. Arsenal 4-1.
Yeah.
Come on, the mighty Arsenal. And we had a couple of glasses of champagne to celebrate. And
after what else?
Well, a few.
A few beers.
A few beers.
Oh, beers and champagne on a Sunday night.
Yeah, feeling fine. Anyway, he sent me a text yesterday saying he's not sure he's ever felt so ill. But he's gone long the S&P as the Trade of the Week, so there you go.
Oh, well, it worked yesterday.
Right, Kingfisher. Kingfisher have been out with numbers. Where are they? Trading update. Strong UK performance. Full-year profit guidance has been upgraded. So they're now expecting 540 to 570 million pounds on an annualised basis, as opposed to 480 to 450. So that's a decent
7% increase.
Decent increase. They're up 6% in the auction so far this morning. So good for anyone that's in those. Next, what else are we looking at this morning?
Yeah, EasyJet. Have you got an early?
Next up, 1.2. EasyJet is EZJ, isn't it? The ticker. They're down 1.75% in the auction.
Are they really?
They are indeed.
God, that was a wrong steer.
Grab your belt. That's for you. Woo. That's for me. Ring-a-ding-a-ding-a-ding-a-ding. There you go. Double ring dingers. Right, Games Workshop as well. Of course, we're looking at.
Now the banks are up on that news that they're not going to get taxed. All they got to do is give her a big thumbs up.
But that's not new news, though. We knew that last week they weren't going to get taxed.
Oh, really?
Yeah. This is why the story is interesting, because it's...
Why are they up so much, then?
Them asking nicely as opposed to the actual story themselves. But good for the financials there. Barclays probably not rallying on the fact that Revolut is now bigger than it, but welcome nonetheless. My good friend Richard, who will no doubt be calling into the desk as he drops his daughter to school to check out where the banks are.
He can just watch the show.
Yeah, he'll be having a good day.
Right, WH Smith, slow recovery there. I noticed now Maturin talking about shorting BME. So give us the steer on that, Maturin. That's what his models kicked out this morning. Then we've got Diageo up 40 basis points. Next up 60 basis points. And yeah, that's about the move of it. It's the losers that are perhaps more interesting this morning.
Expo is interesting, given the fact that what we were talking about with everything to go with copper, but I imagine that's going to be to do with the peace plan in Ukraine, perhaps.
Yeah. Huge day yesterday. Huge.
Yeah.
Right, we've got Sainsbury's and Tesco's down on the day. So are they concerned about the pockets? What's going to happen?
And this is the funny thing, right? Because you're now seeing everybody react to the leaks, right? So what have they said about food? What have they said about the gambling stocks? Flutter still down and kind of still under a cloud there. Antos Glencore, off the back of the copper story, perhaps up 1.5% and 1% respectively. Travis Perkins moving higher with this upgrade to Kingfisher, one would imagine.
Yeah, definitely.
Kingfisher's still not out of auction, by the way, up 6.7% as an indication.
It's a shame that's not a tighter spread, because that would be tempting one to trade this morning. I think they could end up 2%, but it's just, you're almost paying 50 basis points in spread there, so I can't do that. What else we got? Should we have a look at Europa?
Have a look.
We've already got Joe waiting outside to come in with Angeline, so we can run through them quick. ASML up 1.7. Rheinmetall bouncing, that's good news, up 1.2. Then what else, Luke?
So then you've got SocGen up there with the banks. I saw BNP and Paribas also up there, so kind of definitely continuing that move that we're seeing so far in the UK. Keyring up there, where's LVMH? Nowhere to be seen, so Keyring up a lowly 0.6. I mean, it's a bit of a mixed bag. There's nothing specific there that I'm seeing.
The auto's down. So BMW, Volkswagen and Porsche all down between 30 and 60 bips.
And then you've got Hermes down 0.2 and LVMH down. So I wonder if Keyring has had some form of rating change, bankers preferring Keyring over others. I'll have a little dig.
Do you have to be invited in to buy a Birkin in Hermes? I saw something on social media over the weekend where you can't just walk in and buy a bag for 10 grand. You have to be invited to an appointment.
I wouldn't be surprised.
What is going on with people's heads?
I wouldn't be surprised. I was in Paris last year, and my wife had, saved her bonus, and she treated herself to an LVMH handbag. She's been looking forward to it for years, and she had the money, she saved it, fantastic. An LVMH, so Louis Vuitton, you could go in and just buy a bag.
Oh, certainly, yeah.
Of course, in the flagship in Paris. It's actually a beautiful little shopping experience. Thoroughly recommend it for anyone that can. But yeah, I don't know about Hermes. Just not with my money, yeah. She can do whatever she wants with her money.
Right, we got Kingfisher.
Kingfisher
going to open in 1 minute.
Still now indicating 6.7% higher. So we'll see how that uncrosses.
Let's have a look. That is back towards the high. So 18 pence, £3.08. So we're going to open
312.
312.
312.
312 takes you back towards the highs. Let's have a look. That could be an interesting one for a breakout. Again, if tomorrow goes well, where does that leave Kingies? Just above that September of last year is where you're looking. 317 first breakout, and then 332.
And just for those that don't know, hopefully it's common knowledge, but Kingfisher's brands include B&Q and Screwfix. They're the big UK brands that are in the Kingfisher group. Definitely worth knowing. They've also got businesses.
They still have the French one.
Yes. They've got Castorama in France and Poland. They have Brico Dépôt in France, Spain, Portugal, and Romania.
So funny.
There's a word that I can't pronounce.
My first ever job in investment banking, September the 10th, 2001, was to do graphics on a breakdown of Kingfisher, and it had most of the same businesses in there.
Nice. Well, just get Gemini to do it. Right, we're out. We're open up 6.6% and coming straight off. Opened at 312, now sharply trading 310, 309. So coming straight back down off the back of that.
Yeah, I'm not sure if there's much to do there, really. That's tricky. So, but we said it's about 7% upgrade to guidance. So that is, you know, pretty much the right price, up
5%.
Up 5,
6%, yeah.
Yeah, maybe. But again, really tough to buy these things ahead of tomorrow because you don't want a big disappointment for the British consumer.
Are you doing anything live tomorrow? Are you going to be on the dealing floor with your...
We're in here. So we're doing a live special about 1 p.m, 1:15 tomorrow. Myself, Chris, and Axel will be in here. Hopefully Axel will have recovered. And we'll be bringing you all the latest from the budget. So yeah, if you're around at 1 o'clock, then tune in. I think we're the first ones to go out. There's, what's the political podcast? Politics.
Oh, the rest is politics.
Yeah, but there's one called Politics
Live, I guess.
Currency, Political Currency.
Right.
Political Currency are going out at 3 o'clock.
Live, though.
So, yeah.
Okay, cool. So we're going to come out as it happens.
Punching. Good. Right, we've got Dicko coming up to talk about Defence Holdings and Pensana, amongst other things, in about half an hour. But first, we've got Joe Clement, and he's going to be joining us in about 3 minutes. Luke, thank you very much this morning.
You're very welcome.
Back to work. We go and make me some money.
Yeah, let's go see what we can.
The Star PCM.
See what we can move today in your favour. Thanks for joining us, guys. We're going to be jumping to a Guess the Chart. Where's the chart from this morning, guys? It's a United States of American chart. Okay, go.
Calling the names and we're bound together in this trading game. Peers with his visions of silicone dreams. Axel with trades that cut like streams. Chris in the numbers, John in the ground, and Simon's gold keeps spinning around. But there's a hush when the riddle starts. The hidden lines, the secret marks. Phil leans forward with a knowing grin. Let's see if they can guess it this time again. Oh, guess the chart. Raise your hand, take a part. Through the lines, through the years, through the shadows in the dark. Phil's been trying hard to fool us from the start. But we're laughing as we're singing while we're guessing the chart. Kate's still running, chased by fate. Mattering guards the discord gate. Andrew drops movers, the market shakes. Pelicans are waving with hands that break. Bossy's laughter, Jugger's song. Away from the numbers, keeping us strong. Together we trade, together we jest. Together we rise to Phil's latest test. The candles flicker, the chart unwinds. A mystery hidden in crooked lines. We're leaning closer, the guessing game, and smiling. We know it will never be tamed. Oh, guess the chart. Raise your hand, take a part. Through the lines, through the years, through the shadows in the dark. Phil's been trying hard to fool us from the start. But we're laughing as we're singing while we're guessing the chart. And the stomp of feet and the clap of hands as the market moves like shifting sands in the breaking.
Hey, trader friends, welcome to the show, and I am joined by Joachim Clement. Welcome, welcome to Expert Edge. We have been waiting for you because, clearly everyone's been talking about the Google, the latest NVIDIA news, Meta as well, TPU versus teraflops. But we've talked about this many times, and for those of you wanting to let the dust settle, but still wanting to take a position, energy is a good place to start, isn't it?
Yeah, it's not too bad. So the energy sector overall is one of the things that have done extremely well. Beginning of the year, I was overweight energy, but then I kind of got a little bit scared with the Iran thing and all those things. But I would say there are definitely pockets of value with companies like Technip and kind of other oil service providers that I think are more interesting than the big BP Shell conglomerates.
Right. So just showing Technip here as we're talking about that. Of course, the BP and the Shells, really tough place for them right now because they are all very quickly trying to maneuver back to petroleum after, as we know, trying to go beyond petroleum, and then Trump 2.0 happened. So, you know, there you go.
Well, it's not the first time for BP. I mean, they did the turn towards renewables in 27, 28, and then basically were forced to cut all their renewable investments after the Gulf of Mexico tragedy. And then they did another turn in 2017, 2018, and now they turn again. So BP has a good story behind it. There's a reason why the company has underperformed for so long.
And the reason why its share price as well continues to you know, be quite volatile there. It is slowly coming back up after that April period, but if you go back to the left, it is only still trying to get back to highs seen in February 2025, and before that, July 2024. So still quite a climb to get back to the heady highs that it saw way back in 2023. Right, so what should we start off with? I know that you are in town, and also you're talking about the geoeconomic decade.
Yes. So, shameless self-promotion.
Oh, never from your...
Never. We would never do that. But the good news is I'm a banker who doesn't care about money, so it's self-promotion for all those things that I give away for free. So 5 years ago, I wrote a book on geopolitics for investors for the CFA Institute. And they came back to me earlier this year to ask for an update 5 years later. And that has been out for like the last 3-4 weeks now, called the Geoeconomic Decade, focusing on the trends that are shaping this decade, plus giving investors a framework of how to think about geopolitics and how to incorporate it into their investment decisions. However, having said that, it's all very much from a long-term perspective. So this is not a trading book. This is for multi-year investors. It's written basically for fund managers, for people who are managing their portfolios for 5 years or more.
Nice. And also, there I see here is the opportunity, if reading's not your thing.
Reading is not your thing. If reading is not your thing, you should not be an investor.
Just putting that out there because, you know, since the internet, people have, you know, the attention span of a gnat.
Yep.
You know? So it's always good to offer options. So you're also going to be talking about this, I hear?
Yeah, next Monday, 12 o'clock Germany time, continental European time, 11 a.m. UK time. The CFA Society Germany has set up a lunch seminar, again, free of charge, as you can see here. And it actually is an event across Europe. I will talk a little bit about Europe versus Russia and other things that I mentioned in the Geoeconomic Decade. And as a bonus, I will give you a glimpse of how I think the next 5 years will develop based on the stuff that I produce behind the paywall for my employer. So you get some nice extras if you dial in next Monday.
Right. Any of you have questions surrounding this, do put it in the chat here.
You already had one?
Yes. And also having a look at some of the other things that you are watching very closely. I believe Iberdrola is one of them. This is, of course, a renewables company. and also SSE. Let's start off with SSE first, because I know lots of people here have positions in SSE. Here we are.
Yeah, did quite well, as you can see. Had a really big boost after the latest results.
Nice green
SSE is one of the major electricity providers here in the UK for both the wholesale and the retail market. And the reason why I've been looking into companies like Iberdrola and SSE is because I noticed that if you look back at the performance 2025, it's been a fantastic year in Europe, not just in the US. Actually, Europe has outperformed the US, haha. You would normally not think of the utility sector as an outperformer in a year when everything was risk on. But the utility sector has been the second best performing sector this year in Europe after banks. And you wonder why. Well,
what are you going to say? Anja's favorite word here.
Data centers.
Yes,
absolutely.
Everyone talks about, will it be the, will it be the TPUs? Will it be the teraflops? Will it be this chip, that chip? Look, people, it doesn't matter.
They all need electricity.
Need a lot of energy. So if you're going to take a position on that, but you're not sure about where the dust might settle in chip world, then go with the data center.
The electricity providers.
Yes.
Go with the companies that generate the electricity that are needed by every data center.
Yeah.
And to give you an idea, over the last 5 years, electricity demand in Europe has grown by about 7 to 10% per year on average. Thanks to data centers, we expect it to grow by about 14-15% per year over the next 5 years. And in Europe, in continental Europe and in the UK, it is growing towards being more than 10% of total electricity demand. So what you're looking for are companies that benefit from the data center build out in Europe. Because thanks to GDPR and other European regulations, more and more data centers are not built in the US. Obviously, that's where still the biggest are. But the growth actually comes in Europe as they are trying to locate it within the European Union for regulatory reasons.
So lots of clients that have positions in SSE. I have a position too. Luke Moore, that you just met, he's got a position in SSE too. I believe Richie Rich also has a position, and we have seen it touching a record high after unveiling this $44 billion investment plan.
Yep.
And many analysts out there, including Jeffries as well, saying that they see this new plan as very, very positive. How much growth are we looking at here? Because obviously, one looking at this chart would say that, well, a lot of that is factored in. Are we still going to see, this growth? This is the weekly chart. Let's have a look at the monthly there and go left. Are we going to see further upside for this price action, given it's had that big jump already?
Yeah, so in the short term, I think SSE is overbought slightly, but I am still in the bullish camp on a 12-month horizon for SSE. If I were to be a punter and a more short-term oriented investor, I would probably sell my SSE positions and move into Iberdrola, because Iberdrola is one of the big suppliers of energy in both the UK, it's one of the top 3 suppliers in the UK, and in Spain. And Spain is the big new hub for data centers in Europe. Both Barcelona and Madrid, thanks to extremely low energy prices, because they've got so much solar energy that Spain has amongst the lowest energy prices in Europe, and that incentivizes a lot of data centers to be built there. And Iberdrola, obviously one of the big ones there, providing a lot of solar and wind, and hence being in pole position to provide the electricity for those new data centers that are going to be built in the next couple of years. So I think when we have had the news about SSE, I think for Iberdrola, 2026 is the year when they will announce more and more investment plans. And we estimate that there's about EBITDA opportunity of around 800 million to 1 billion euros in the next 3 to 5 years for companies like Iberdrola.
3 to 5 years. Next one on your list, and Like you, I've worked in Finland a lot, so I'm very, very excited when you come to me with Finnish names. Fortum.
Yep. Lovely Fortum, Finnish utility company producing almost 100% clean energy, mostly nuclear power and then water.
Hydro.
And as a result, is a really preferential provider for data centers in Scandinavia. And let's face it, data centers in Scandinavia are also growing faster than in most of continental Europe or the UK, simply because unlike in Spain, you actually can save on air conditioning because it's cold. So that is the advantage of Finland and Sweden, where Fortum distributes its energy to. The drawbacks are growth isn't quite as fast as it is in Spain or in the UK, simply because there are less clients sited in Sweden and in Finland that would need that data center power. And then there's the proximity to Russia. And Fortum still has power plants in Russia that it can tap into, which is always a bit of a geopolitical tricky thing.
Interesting, interesting. Those of you with questions already, please put them through. We've got some that we are about geopolitics, so we're going to save that for a bit later. Whilst we're talking about this, I have been emailed by one of our clients asking, could you ask Joachim what his thoughts are surrounding mood music that suggests that chips that are going to be less power hungry in the future. Does this mean that the whole energy play with data centers, is it effectively shortened?
Yes, it is. And I am very much a fan of Alphabet these days and the TPU chips. Rather than the NVIDIA chips. Just given the valuation differences, it's an easy call to make. And we've just heard this morning that Meta is thinking about investing in Google TPUs to get their hands on that.
Well, Google's got the full stack, right? Yeah.
Google's got everything. And they've basically worked on privately and under the radar cornering the entire AI market. And I do think that people... over the last 6 weeks, I've been on roadshows through Asia and the UK, and people always ask me, it's like, well, if you compare this to the dot-com bubble in the late 90s, is this 2000 or which year are we in? And I'd be willing to stick my head out and say this is 1998.
Ooh, Joachim's sticking his head above the parapet.
And the reason is that, yes, the AI trade is expensive, but I also am sticking my head out and saying that the Fed will cut interest rates far more aggressively than people expect.
Interesting.
I expect 4 to 6 rate cuts next year.
They're going to pull the stops out, is your expectation?
Exactly. Not just this December, but then basically going below 3% by the end of next year. And that will fuel the AI trade even more and push it into a bubble. And to me, the parallels are with 1998, when after the Russian crisis, LTCM, the famous hedge fund, it was on the brink of collapse, or actually collapsed. And what did the Fed do? It lowered interest rates in order to protect the US economy from 5.5 to 4.5% in a couple of months. And that fueled the dot-com bubble into 2000. And I expect that something similar will happen in 2026, which is why if I were to compare it, I would compare it to 1998.
Interesting, interesting. So it's like, I'm going to say something quite controversial now. I'm going to stick my head above the parapet as well, given you've done it twice.
Yeah.
Very rare for you, Joachim, very rare.
Oh, sometimes I'm in a good mood,
So I'm going to stick my head above the parapet because I'm going to say that the whole AI bubble discussion, yes, you have to be selective, but also the fact that there have been many bears, right? Let's cut to the chase. There have been many bears in the last few weeks, but I have stood firm on my longer term portfolio for now because it's almost like trying to bet against a kid that's being mollycoddled by a very big parent that's got deep pockets.
Yes.
So this, no matter how badly behaved that kid is going to be, there's always going to be a backstop.
Oh yeah, and the backstop is called the Fed.
Yes,
The
and Trump
moment the
at the moment.
Fed starts cutting interest rates, and we've seen that, like 4 weeks ago, we had these discussions after the last Fed meeting, or 5 weeks ago, of like the hawkish turn of the Fed, and they might not cut as much, etc. And then basically markets were all pricing in no Fed rate cut in December. And then Nvidia kind of came, and now basically since the beginning of this year, the tech sector is supported again. Why? Because everybody expects rate cuts next week or 2 weeks ago.
Yeah. And so that narrative has come back. R. Sachs coming to the floor with questions. What are your thoughts on stocks like CEG, VST, and GEV, if any? Let's have a look.
Good question. If you tell me what kind of tickers those are, that already gives
Energy Corporation. Yes, I think we talked about this one before.
We did about that. Constellation is probably one of the best plays because it's got a lot of nuclear power. And that.
Oh, don't say that. All my uranium got stopped out as I arrived in KL.
Well, that's your problem. I'm
my
still a
purpose.
nuclear power fan. And
so I was like, bing!
If you actually look at where data centers are being built, there are a lot of them are built around the Atlanta area, where Constellation is the provider of choice. And then the other one that I have a little bit of interest in, because we just helped IPO it a couple of weeks ago, is Fermi America, which is building the world's largest data center, including its own off-grid power supply with gas and nuclear.
Nice, like this?
Yep.
FERMI?
Correct. As I said, they just IPO'd a couple of weeks ago. That is definitely a 5-year or longer play. That is not something for the next 1, 2, 3 months.
There you go, 5-year or more play. This is not a short-term duration trade, people.
Yeah, but they are basically trying to build the world's largest data center in Texas.
Let's see what the other one is. We've got Vistra Energy Corporation here.
No idea, never looked at them.
Let's have a look at the chart.
No clue.
This is the weekly chart here, daily. Yes, it's one that is coming, price action is now falling below the 200 EMA and potentially moving further. If it does close below the low since seen June 2025, then perhaps we could approach the next area of interest, which is around the 8th of May. So just be aware of that, R. Sachs. Let's have a look at GEV as well. This is Vernova, one that we've talked about before here.
Classic. GE Vernova, I prefer Siemens, and that is simply because GE Vernova is trying to obviously benefit from the offshore wind and the entire renewables drive. The problem is that GE Vernova is specialized and competitive in the largest of the large wind turbines for offshore things. And that is actually the thing that is under pressure in the US from the Trump administration, while Siemens is basically along the entire size spectrum, from tiny, like you're a farmer, you want your own wind turbine on your field somewhere, to massive offshore. So I would usually prefer Siemens and Siemens Energy. Similarly, Siemens Energy, actually the ones that make the wind turbines, as a much better play than GE Vernova.
Okay, we got another question too from Andrew McKilvey, one of our solid and loyal Trade Live with IG fans here. Andrew, I'm sure you already know Joachim's view on this because you watch this section and segment a lot. What are your thoughts on travel, holiday stocks like TUI, IAG and EasyJet? I remember you coming on a couple of weeks ago saying you were
airlines.
especially going into the end of the year.
Yep, very much a fan of airlines. IAG, EasyJet in the UK, Lufthansa in Europe. Those are my favorites. TUI, I would say for 2026, probably an interesting one, especially because in Germany, I expect real wages to grow up and people to have more money to spend as the economy accelerates more and more. And that should help TUI, which has obviously much of its business in Germany. But to be honest, I haven't really looked closely at TUI in the recent months.
Now, EasyJet, this one is interesting because they've reported better than expected operating profits. So
As they should, yeah.
They should. Upgraded its medium-term targets for its holiday business and met the targets early. So it's a bit disappointing in that its shares are down almost 2%. I just wonder, I've been scouring the headlines and the wires, Andrew McKilvey, to try and figure out why we are seeing this. And I wonder if it's maybe, analysts say, oh, it's just profit taking, but they don't know what the reason is.
Yeah, I know.
I'm
This
trying
is
to not
my
say that.
expression as well,
Yeah, so that's why I'm trying to find a reason, but there is not one just yet. It's not clear.
No, I could also come up with the other well-trodden path of saying it is buy on the rumor, sell on the news, blah, blah, blah.
IAG also trading lower there, but it is coming back.
Yep.
Go on, IAG, come on. Yeah, it is traversing back after gaining and consolidating, gaining some momentum after consolidating at around that 100 EMA and coming up. Now, I have high conviction with IAG, for better or worse. Bit like a marriage here.
No. I'm with you. I'm with you. I've been with IAG for the last 2-3 years. Yeah.
And so I'm hoping that I will be proven right in the first quarter, if not sooner. We've got a bit of time left. I know we are running out of time. We had someone asking about a quick synopsis of your thoughts about geopolitics and where might the flashpoints be. Phil, help me out here, was further up the chat that's now filled up. The other thing too is Rasa Vadai asking if you could discuss defense holdings. If you know, I think that's for later. We've got Graham coming in.
Yep.
But most importantly, your thoughts. And I know we've got Simon French coming in, but just because we're on the cusp of the budget, your thoughts on the budget.
They made a right old mess out of it.
So what is it? Fiscal fandango?
It's just ridiculous. It's like they should. If you ask me, and I might disagree with my boss tomorrow, so check with him. But I would have gone for income tax increases, and in order to put clear air between the current government finances and our fiscal rules and our fiscal ceiling. Because at the moment, what they seem to be doing is they've decided not to break their manifesto promises and not hike income tax rates. But what that does is it kind of creates another patchwork of tiny little taxes here and there, a little bit of headroom. And the big risk is that as bond yields rise, we're going to be in the same situation again in 6 months' time. And again, 6 months of uncertainty where businesses don't want to invest because they don't know what's going to come in the next budget. And that's really how you ruin growth.
And on that merry note, thank you so much, Joachim, for coming in. Arasax and also Andrew, I see all your questions. I will get them asked later on, but we've run out of time because we've got Graham Dixon coming up next, waiting in the wings. So thank you for watching. Do keep watching. Get your questions in for Graham. But for now, we will bid Joachim adieu.
Thank you very much.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, Join the conversation and be inspired to make moves. Welcome to The Art of Investing, a brand new podcast to help you achieve your investing goals.
And I've seen at first hand the power of the wealth creation that one has been able to obtain from this industry. What we're going to do is we're going to put it into action by creating our own model portfolio.
We're going to be talking about the big indices that are around the world, because that is probably some of the safest ways for you to invest your money.
We need to bring this to everybody and help them then take control of their own investment story.
Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris CJ Fellingham, every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. Welcome back, everybody. It is Graham Dixon back in from G-Force Capital.
Thank you. Nice to see you.
It's great to have you back on.
It's great to see you too.
So far, so good. You've had some cracking calls this year. So very excited because we've got two new names today that we're going to chat about. But let's go over the old ones first, shall we?
Of course, absolutely.
Shall we start with Pensana?
Pensana, yeah. So as you know, I think I came onto the show about a few months ago, and it was it'd come from, I don't know, 25p. By the time I'd got on the show, it was probably in the mid 60s. Can't remember exactly the price.
That's exactly it. We got the chart there. You're spot on.
It was the mid 60s, and it just carried on going. And I think that was just the whole excitement in the whole rare earth sector, particularly with magnetic metals. It peaked at 180, 181. And then had a giant fall.
And this was perfectly in line with the likes of MP Materials. And
correct.
Yeah.
You're absolutely spot on. You've done your research.
Yeah. Well, I felt the pain. I've still got it.
I'm so sorry. It's kind of strange because MP Materials has bounced from its lows.
Right.
But Pensana hasn't.
That's interesting.
It's got stuck. And I don't know if it's to do with this whole budget thing or I really don't know what's sort of keeping it suppressed.
Yeah.
But they've just been working overtime, these guys. So they've done a deal with this company called EVAC. It's actually a long German word, but I won't even try to pronounce it.
Okay.
In South Carolina. And they're going to actually...
They did a deal.
Yes, they did a deal with them to process. They're going to provide the feedstock, Pensana and EVAC are going to process this into the fine rare earth magnets.
Okay.
Yeah. So they've done a deal with them. They've done a deal. Well, they've done a letter of interest with the Exim Bank, or the Export-Import Bank of the United States. So it's done a deal with the government. It potentially, can't say definitely yet because it's a letter of interest. And that's to finance $160 million of debt. The debt's already covered with Pensana, but if you can get American debt, then I suspect it's probably more attractive and a more vested interest with Angola, Pensana, and America. And then the last thing that they've done, which I have just to remind, is they've agreed to do a drilling program for 25,000 meters of drilling in Longonjo, which is their main asset in Angola, and with the intention of making that the biggest rare earth magnetics metals company in the world.
Wow.
Yeah.
Okay, so
everything's ambitious.
Despite the share price, and that feels like it's the more general sector, everything's on track.
It is on track.
And progress has been made.
Massive progress. The market cap, they've got 300 million shares in issue. Share price is about 90p, so it's 270 million market cap. Do you like my master?
Very good.
I think MP Materials market cap is about 11 billion. There's just a massive gap between the two. And MP's got home advantage because their mine is in America.
Yeah.
But if you're processing the metals in America, or through Pensana and their partners, I just think it's just a question of time before this gap narrows.
Okay.
Yeah.
And just remind everybody, where are they in the stage of production or pre-production?
It's pre-production. They should be in full production possibly the end of next year.
Okay.
Or Q1 2027.
Yeah.
Or the ramp-up phase. I can't really say full production. Ramp-up phase, and then full production later in the subsequent years.
But certainly fully funded with those deals.
Yeah, they're fully funded, which is it's a good position to be in, because you don't have to worry about they're going to do a sneaky fundraise around the corner.
Yeah. We've all
seen that.
Seen that. Yeah.
Yes.
Felt it. Yeah. And then also with the sort of the demand side of things, then we saw the deal with China, which is why the sector came off. But this isn't going away. We're set to stay for rare earths being a hot topic.
The demand for rare earths is almost infinite, because it's now evolving. We didn't hear about robotics. Now we're starting to hear about robotics. We're hearing about these super fast trains that now need powerful magnets. I mean, I think even Musk has got that. Is it the Boring Company, or was it Hyperloop? I can't remember the name. Maybe they're working together with each other.
Boring, yeah.
And that's going to require a lot of magnets. And of course, you've also got, I think, is it in Saudi Arabia? They've got that, I can't remember what it's called, that line. It's about a mile long or something. Maybe about a lot longer than a mile. But again, if they're going to use trains for that and super fast trains, again, you're going to need magnets. Of course, the electric vehicle.
And no update or no change in Angola's
politics, or
yeah.
As far as, no, I don't think so. I think it's pretty. You still get cases of civil unrest, and it's quite a militarized zone. In fact, my business partner James Lawson Baker is in Angola right now as we speak,
on the ground.
And he showed me a photograph from his hotel room, and you see people in army uniform with all the guns, etc. So it's. I don't think it's super safe to go and walk on your own. Maybe I'm wrong about that, but he was advised to just be a bit careful.
Okay.
But otherwise, it's a good place to do business. I mean, Afentra are there; they're happily doing business in Angola, and I think it's quite an attractive destination from a business point of view.
Okay, good stuff. Defence holdings. Let's have a look at that then. Again, we had that incredible pop that was just mind-blowing up to 4p.
Yes.
And then, what do we think since? What's the sort of update?
So like with all these sort of new industries, which is a defence AI business or a sovereign defence, right? It's kind of new, and when you get these new industries and new companies going into these new industries, you get tremendous excitement, and this is like the hype phase. Right, and we kind of caught it quite early in that hype phase.
Oh yeah.
And I think now it's time for show me the money.
Yeah.
Right.
True.
Give me some contracts. The market wants something. So I think there's an element of you've got the collaborations, and they are brilliant collaborations. With Google and Oracle. I mean, so they are really, really fantastic names to have. And I'm sure you just can't sign collaborations without having their consent and all the I's dotted and the T's crossed, etc.
Absolutely.
But I think now the market is looking for, let's talk
actual revenue.
Now. Yeah, revenue, etc. Now, the board is fantastic. It's a world-class board of advisors and directors. So you've got Lord Horton, who is a field marshal. You've got Andy McCartney, who was the former CEO of Microsoft Ventures in the UK. You've got Anthony Stasica, who's like this legend in the army, who runs his own clothing business. And then you've got Bertie Bassett, who is like very, very commercial and a bit of a legend in the army as well. So you've got really, really good. If they cannot win contracts, then we might as well pack it all in and bake bread for a living.
Here's this from early September, of course. There's Lord Horton.
Yes.
And yeah, what about sort of new news? Since your last update, we got the Great Board, so that's in place, and then they've there was the convention. Was that right? Where?
Oh, at the Excel Centre.
Yes.
Yes. Yeah, they had that, and I think they had a presence there. But that was their collaboration partner, which is called Whitespace. So Andy McCartney is also a director of Whitespace, happened to be there, and I'm sure they made very good connections and progress there.
Yeah.
But they do have this project. So I think I may have mentioned it before, Project Ixion, and that's something which where they basically, I think what they're trying to establish in real time is, are you friend or foe? Imagine that you're, a United Nations set of peacekeepers. You got the Danes, you got the Norwegians, you got the Brits, right? And maybe you've got some enemy. I don't want to say who it might be, but whoever it may be.
Yeah.
How do you distinguish? All the tanks look the same. They're all green.
Yeah.
So there's this thing about making sure you don't get friendly fire. So there's this whole thing real time. Can we deploy missiles on this particular target, etc. Friendly fire and prevention of unnecessary injuries against civilians.
But still a micro cap, isn't it, in terms of market cap?
Yeah, I think it's about £43 million.
Yeah.
Yeah. I mean,
okay.
What is a micro cap now? Is it less than 10 million? Is it less than 50 million? I don't know what it is these days, but
yeah.
It's certainly come from a micro cap, and arguably it still is a micro cap.
So a little bit of revenue, or evidence of the revenue could still make a big impact, couldn't it?
I think the budgets on defence are just so massive, and the direction of travel is one way. It's only going to go up for the foreseeable future.
Yeah.
And also this thing about, we've, are in bed with America, always have been, but there is this sort of, let's look after our own mentality, particularly in America. And, if we needed certain help and, missiles, would they provide that for us at a time of need? So I think there is now this hang on a minute, we need to be able to fend for ourselves. So there's this sudden rush of, let's invest in defence to make sure that we are prepared for all eventualities.
Okay. Right, time for a news story.
News story.
We are going on to WeCap.
Yes, WeCap.
Now, tell us what this is.
Well, WeCap is an investment company listed on Aquis. Now, Aquis used to be, it used to be a graveyard for small caps. It's like, oh God, you're on Aquis. Okay, well, I'll leave that for my kids.
Okay. Yeah.
No longer. And the company that changed that was your friend, Smarter Web.
Yes, indeed.
And thank you, Andrew Webb. I watched your interview, which was absolutely fantastic. He really deserves a medal, that guy. I really admire him a lot, and his whole attitude is he really believes in what he's selling. And anyway, so him primarily, or his company and other Bitcoin treasury companies. There was a flood of them. Suddenly liquidity has come alive, and this whole thing about AIM and standard listed companies and Aquis, I think is now no longer. I think Aquis is just as good. Now, WeCap are listed. They've been listed on Aquis for some time.
Okay.
They are an investment company. They've got a couple of smaller investments, but their main investment is a company called WeShop. And WeShop is an e-commerce business, right? Okay. So I don't know if you've ever been on these websites or platforms or apps where you can buy something and you get cash back. You ever done that before? Have you ever heard of that?
Yeah.
Yeah. So basically what they're doing, instead of giving the shopper cash back, they give you shares in WeShop. Yeah. Ooh, what a concept.
Okay.
Yeah. It takes a bit of a while to get your head around it. But
and what kind of stuff can I buy?
You literally, it redirects you. So they've got, I think in America, they're targeting 1,500 retailers.
Okay.
In America. So they've just launched. WeShop have just floated on the NASDAQ. Floated on the 14th of November.
Wow.
$20. I think it peaked at $257 within a week. And I think last night it closed at I don't know, $130, $140. I didn't take a close look.
Okay.
But yeah, it basically redirects you. You go on their app and you say, right, what app do you want to go on? Or you can even type the product, and it redirects you to whichever retailer you want to go to. And so you're then contracted directly with the retailer. The retailer's happy that you've been referred.
Yeah.
And they will pay WeShop a cash commission for refer. So WeShop get all the cash, and you get the shares. Now, typically, that will range, I think, somewhere between 5 and 10%, something like that. Yeah, in terms of so if you spend £100, you might get £5 or £10 worth of shares in WeShop. WeShop in turn will get somewhere probably between 10 and 15% in cash from the retailers.
Okay.
So they should, in theory, earn a lot more than what they're giving out. And so if the model works, and that's the big question, if the model works, you're going to have a lot more cash than the shares you're issuing. If you end up buying your shares back, then this whole share issuance thing, when you're giving shares out to your shoppers, will be cancelled by the shares you're buying back, right? That's the theory, but it only works if it's successful. And yeah, sorry, you want to ask a question?
So your two risks are that people don't use the app, obviously.
Yes.
But that the shop contracts the payment to you. Yes. And there's an argument with
you're still gonna get your product, regardless of where WeShop end up. So if you're just purely as a shopper, you don't have to worry if WeShop goes bust or if it thrives. You should. But the idea, if it's successful, then you could end up having a product that's vastly discounted. It'll take you about a year before you get your shares. So that's a bit of a catch. But I understand that's the same. Why?
Strange, isn't it?
Well, I guess it takes a while. You get returns from shoppers.
Okay.
So just in case, so you need to validate that. So that's another reason. But also, I guess, just to create some orderly market with that sort of thing.
Okay, so here's the WeShop price since it came onto the Nasdaq then. So 19th of November, is that?
I think the 14th was it was a Friday the 14th. I remember it.
Oh, okay.
Yeah,
that just.
It doesn't quite go there, maybe.
Yeah,
first shot was $20. I remember seeing it.
Yeah, there we go. So then it traded around 30, 40, and then, like you say, whoosh up to as high as 250.
Yes.
And it's settled around the 130 mark.
That's it. Yeah. Yeah.
Okay, so there's this. You can invest in this on the Nasdaq, but then what's
right. Here's the interesting thing. WeCap owns 11.8% of WeShop. Right now, the market cap of WeShop, they've got 10.9 million shares in issue. That's 130. So they're probably about 1.5 billion dollars.
Okay.
WeCap has got 440 million shares in issue, and their share price is, I don't know, what is it, 2.8p. So market cap's about, I don't know, £12 million. Turn that into dollars, it's about, I don't know, say $16 million.
Right.
Versus an investment that's worth, I don't know, it's probably worth.
So why the difference?
$160 million, much more actually, probably. Why? There's lock-in. So WeCap cannot sell their shares for a year. So who knows where WeShop will be in a year's time. But the discount is just so vast.
So it's like an option.
It's like an option.
Yeah.
Yeah, exactly right, actually. It's a very good way of putting it. And I think what will happen with time value, you see, as time goes on, I suspect the price will actually get closer to the real valuation of WeShop. So yeah.
So you've got, let's say a 1 year call option on something that is 10 times the size, and you hold 11% of that, and that's generating more cash than it is giving out on shares.
In theory, not yet, because they've only just launched in America. So they actually launched the app in America on the 14th.
Right.
Maybe the 15th or something like that. and they've just debuted. I think one was conditional on the other, that they had to have the listing first in order to launch the app. So now they're in America, people can go out and buy it.
Okay, here we go. Here's the website. It's a great idea, isn't it?
It's a brilliant idea.
And it's in the UK as well.
Yes, yeah, you can use it in the UK. And the whole analogy is like, well, if you're on Amazon, imagine if Jeff Bezos had done this all those years ago, right? Instead of Amazon keeping all the profits, they just shared a little bit with their shoppers. Then Jeff Bezos probably wouldn't be as rich as he actually is, and shoppers would probably be very grateful for their kickback.
Nice.
Yeah.
Right. Okay. Yeah. Good story.
So yeah, little. And by the way, I haven't said that. I've got. Am I allowed to do a little plug? Because
please.
I've done launched a new podcast. It's called Monday Upbeat Markets, or MUMS as the acronyms.
Monday Update.
Monday Upbeat Markets is on YouTube.
Upbeat Markets.
And anyway, we talked about. We had a former director of WeCap on our show yesterday. So there you go. You can listen to the interview that we did with John Taylor yesterday.
Great.
So have a look at that, and
there we go.
You'll get a lot more information from that show.
Brilliant. And you've bought a bus as well.
Yeah,
When
we
did
bought
that
a bus.
happen?
Oh yes, yeah. Well, Boris loves his buses, and so do we.
Yeah. The number 77. Good stuff. Okay, and so the market cap again, it's very small market cap.
Yes.
High risk.
Yeah.
Large spread, right? So those are all the negatives.
Yes.
There's about an 8% spread there, but a very interesting story.
Yeah, it's a massive anomaly between the valuation of WeShop and the valuation of WeCap. So, either WeShop is overinflated.
Can you not just short WeShop?
Try and do that. You try and get the borrow. There's so few shares in issue. It's about 10.9.
Well, not for long, because they're creating new ones every day.
Well, they will do. Yeah, but those won't get released for a year.
But that's why it is, because they're creating so many shares that it dilutes that company.
Yes.
So their WeCap are being diluted, aren't they?
They will ultimately get diluted. Yes. Yeah.
But you hope that the share price goes up in the meantime because they're earning cash. So in theory, the price should go up.
Yeah. I mean, if WeShop aren't successful, then that's not great, because they won't be able to generate enough cash to cancel out the shares. But if they are, then it's a great situation.
Yeah. Good. Right, that's definitely one to look more into.
Yeah.
And then the final one today is another resources company.
It is indeed, yeah. By the way, I should have said I do own shares in Uplands, which is the one we're just about to talk about, but also in WeCap, Pensana, and Defence Holdings, just for transparency
People
purposes.
used to say, "Oh, you're just talking your own book." Well, obviously, because I'm going to own shares in the best stories that you've got, right?
Yeah. So I hope, So Uplands, I've got shares in. Ticker's UPL. Market cap's about £48 million. They've got about £3.5 million in cash as of June.
Okay.
Low cash burn. Now, they are focused in a region of Southeast Asia, particularly in Malaysia, a region called Sarawak. And apparently, the rumour has it that Sarawak is laden with oil. It's totally underexplored, and it's analogous to going to the North Sea in the 1970s. If you go out to onshore Sarawak, make sure you're wearing your knee-high wellies, because you're going to be saturated. So they've got onshore Sarawak, and then they've also got neighbouring Brunei, which they don't have the licenses for, and this is the risk, right? These are the risks. They don't have the licenses yet. However, they've just done a deal with this legendary oil. I don't know what you call him. Corporate. He's a corporate guy.
Baron.
A baron. Yeah, that's a good way of putting it. His name is Mark A. Brunner. He's an oil veteran. He was the founder of a company called Ultra Petroleum in 1996. It debuted in the US. I think it was at 15 cents, and it peaked at $200. Right. So if you put $1,000 at the initial price,
oh wow,
and then sold it at the peak. That was $1,000 would have hit $1.3 million.
Yeah.
So this guy's got a real sort of following. Anyway, his vehicle is called Lost Soldier. Lost Soldier's got some assets in America, and they've done some kind of like, you scratch my back, I scratch your back, right? So Lost Soldiers invested in Uplands. Uplands have invested in Lost Soldiers.
Okay.
So there's no real money was exchanged hands, as from what I can see. But there is an investment in theory on both of them. So they both got exposure to each other.
Yeah.
Mark Bruner's got an option himself personally for 100 million shares at 5p. And I just find the whole thing, very, very interesting. I think, to have Bruner getting exposure, some American getting exposure to, Southeast Asian asset, I think is highly unusual, especially when he's been focused in North America.
Do you want me to go and visit it?
I'll
get boots on the
Whilst you're on the way to Macau, perhaps.
Well, I was thinking of New Zealand for January.
Okay.
So I need to stop off somewhere. So why not?
Yeah, take your
go
Willie
visit
boots in your case.
And how long do you think will be until you would see some production or some more?
Well, this is interesting. He is really focused on these sort of unconventional oil drills. So this is like where oil is like super stubborn. It's under this like source rock. They've got conventional oil, which is like easy to access. But the unconventional stuff, which is where he's really good at, is where you have to drill like 3,000 meters deep and do horizontal drilling and whatnot. And they can get through the source rock and extract the vast quantities of oil that are stubborn and trapped.
Okay.
And so that's his speciality. And I think in that area, it's abundant. No one's really tried it. And I think that's where he is seeing. So I think there could be like early cash flows from this. But first of all, they need the licenses.
Yeah.
So, I think you need the finance partner first, which I think they've got access to resources.
Okay.
And then secondly, you need the the licenses. But I think one is probably conditional on the other, or the other way around. So hopefully the licenses come through, and away we go.
And how's the market cap looking on this then?
I think it's about 48 million quid when I last looked at it.
Okay.
Yeah.
With an oil-rich area of the world that is relatively untapped, and with experienced people at the helm.
Correct. Yeah. So let's see.
Which one out of the two would you have more conviction in?
Oh my word.
Or the four?
Okay. All right. I think Pensana is probably my highest conviction out of the four, because you've got you can see the valuation disparity between MP Materials and Pensana. Yeah. So I'd probably say that's my highest conviction. WeCap's got to be high. I mean, I would probably say Pensana first, WeCap second, or joint second. I would say Uplands and WeCap, and then Defence probably the least. And that's not to say Defence could regain that once they win contracts. It's just at the moment they're in this prove it kind of stage.
Yeah.
And
then you've got another 1,000 companies after that. These are your kind of top four.
Yeah, so, I think so. The ones that I'm sort of focused on. Yeah.
Brilliant.
Does that tickle your fancy?
That's absolutely fascinating. I've got to look more at this wee shop as well, because that sounds like a really interesting structure.
Well, you should just. I'm a shopper on. For example, if you want to go on the train line and spend £300 coming over to IG to return ticket, then why not get 5% cash or WeShop shares?
Graham jumped on the train this morning, and or he was going to jump on the train this morning. They tried to charge him £300 for it, not even business class.
No, I know. I said, sod that, I'll drive in instead.
From Bath.
Yeah, I know. Early morning. But you're used to early mornings, aren't you?
Yeah.
Do you ever sleep?
When Japan's shut. Good stuff. Thank you very much for coming in. That's been really fascinating.
Thanks so much.
Next up, Neville Hill for the budget special. We got the expert in to give you what his thoughts are ahead of tomorrow. We'll see you in about 4 minutes. If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves. Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris CJ Fellingham, every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments like shares, indices, forex, and commodities without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. Every Monday I break down a carefully selected trade setup live in my Trade of the Week. Whether you're new to trading or have years of experience, Trade of the Week will help you to generate powerful trade ideas and execute them with precision using stop losses and profit targets. So if you're looking to enhance your skills and boost your confidence in the markets, join me every Monday for my Trade of the Week live on Trade Live with IG.
Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals.
And I've seen at first hand the power of the wealth creation that one has been able to obtain from this industry. What we're going to do is we're going to put it into action by creating our own model portfolio.
We're going to be talking about the big indices that are around the world, because that is probably some of the safest ways for you to invest your money.
We need to bring this to everybody and help them then take control of their own investment story.
Join me, Rich McDonald, and my co-hosts Mark Spice Holden and Chris CJ Fellingham every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. Welcome back, everybody. Now, this is an absolute honour to have Neville Hill onto the show. Neville, give a little bit of an introduction. How long were you at Credit Suisse, first of all?
I was at Credit Suisse for 22 years, so almost half my life, but getting on for it, yeah.
And from what year? When did that start?
So I joined in 1999 as a, in shorts, as it were. I was just not long out of uni. Spent a couple of years working for the government as an economist in the UK Treasury, actually in the team, which really dates it, designed to take Britain into the euro, which obviously history intervened in. So after that sort of failed project, I thought I'd join Credit Suisse, because what could possibly go wrong? But no, I joined and I actually had a fantastic career there. I became chief European economist there in 2011, right in the middle of the euro crisis, which, I mean, for me, the global financial, it was always something I'd say when, we did graduate come round to sort of talk, and they go, what's the highlight of your career? And I go, well, it was the worst financial crisis in several generations. It was absolutely brilliant to be an economist during that and during the euro crisis. It meant you were able to add a lot of value to the trading and to clients and to sales. And intellectually, it was just an extraordinarily interesting and exciting time to work. So I stayed there till 2022, and then left at that point.
And so, just to sort of give everybody from the other side. So I was at Credit Suisse, first of all, for 3 years, then went to Brevan Howard for 3 years. Because you had all these economists, the sort of the top guys, ex-Federal Reserve voters and all. And I got back to CS and I was starved of that information. So then when Danny came in and he started saying, right, let's get Neville down onto the floor. Let's get him. So you had to come in like literally with 15 traders huddled round you.
I loved that part of it. I mean, that was always the best bit, was the communication, because you felt like you were doing something useful. I mean, I remember if we're trading sort of war stories, during the financial crisis, the morning Alistair Darling announced he was going to nationalise, a whole swathe of British banks, and I sort of got to my desk, I was pouring my coffee, and I thought, oh, blimey, printed off the press release and thought, well, I'd better go and speak to the UK government bond traders, because I imagine they might be interested in how, British government spending several tens of billions on buying banks. And so I popped down to them and said, oh, guys, you probably need to hear this. And by the time I sort of looked up from reading out the press release, like half the trading floor was surrounding me, and it's I'm somebody who likes attention, so having lots of people here was really nice. And same, I remember doing the all-nighter over Brexit and stumbling down to your trading floor at sort of 5 in the morning and going, oh, looks like we've got an interesting day of trading ahead and things like that. So I love that part of it, and actually that was one of the reasons to leave Credit Suisse in the end, was that obviously that was from 2015 on, the investment bank and the trading and markets business was a part of the business that just got shrunk and shrunk and shrunk. And that was really the bit that I loved to do and, got me up in the morning. Yeah. And so what have you moved on to now then? Well, I guess, like many men of my age, approaching 50 at Credit Suisse, I decided to have a midlife crisis. And instead of buying a fast car and finding a blonde and getting a divorce, I ended up, I thought I'd do something slightly more sober. I went to the London School of Economics and did a master's in environmental economics and climate change, because that was something I thought would be very interested in. So I spent a year doing that, which I absolutely loved. And actually, if you want a fairly cheap midlife crisis, people going and doing one of the more ethical ones. Yeah, but also a lot of fun and a lot of interest. So I did that for a year, and then set up with an old friend of mine from back in the Treasury who had spent 20 years working at Daiwa as an economist, and we've set up a small economics consultancy firm focusing on the macro stuff that we've done on a day-to-day basis, but also trying to advise businesses on climate change, and in particular, rather than I think a lot of focus these days has been on getting to net zero and ESG and all of that. Actually, the world we're in is unfortunately one, and as we've seen, in COP over the last few days, is one where climate change is going to keep on happening. So starting to encourage businesses to start thinking about how to adapt to a changing climate, because that will have serious economic effects. And I think, unfortunately, we've not done enough to get to net zero and stop climate change, but we unfortunately haven't really done enough to start thinking about what we need to do to live with climate change, because we're going to have to.
Absolutely. There could be a bit of a change in climate in this country in the next 24 hours. What are your thoughts going into what battle that Rachel's got ahead tomorrow?
I think it's a tricky one, in part because it feels like we've had not just one, but 2 or 3 budgets announced to us over the past couple of months. I mean, it feels like it's gone on forever. It's worse than sort of, when they put Christmas decorations out in the shops at the start of November. I mean, it feels like it's been, budget for forever. So I think we'll all be relieved when it's over. I think the challenge for Reeves, particularly having fed us this idea that they're going to break the manifesto commitment, raise income taxes, which understandably I think markets took very well, at least bond markets did, because it was a clear, credible fiscal tightening. The problem we're going to have to work out tomorrow really is there a decent fiscal tightening on the table? Is the deficit genuinely going to start coming down? And are the measures that they've announced in order to do that, are they both economically and politically capable of working? Because actually, you look back a year ago at her first budget, and at the time the OBR said, well, based on the measures she's announced, the deficit, which was going to be last year 4.5% of GDP, was going to fall to 3.5% of GDP this year. Actually, it looks like it'll be over 5%, so it'll have gone up. And that's partly because the economy hasn't done as well as the OBR expected, but mostly it's because the spending cuts that were promised haven't materialized because politically they were impossible, and the tax increases that were implemented, you're at a point really where the sort of smorgasbord, as they're talking about, of little tax changes in various places. The problem is people can avoid taxes by not doing the things that are taxed, whether that's sending kids to private school and paying the VAT on that, or employing people and consequently paying employers' national insurance. So I think the challenge for us reading through the budget tomorrow is going to be, I'd hope there's a big drop in the budget deficit forecast for next year and the year beyond. If there isn't, I think the market's not going to like that at all.
Okay.
But we also then need to go, well, how is that deficit actually falling? Is it going to be spending cuts you can't get past your MPs? And is it, tax increases that actually don't deliver as much revenue as you'd like to see? I mean, obviously there's a bit of focus on this mansion tax, above properties of 2 million. And actually, from that perspective, it's not a bad tax from the perspective of raising revenue, because people have got to live in those houses. But once again, you can kind of see that people are going to try and avoid that by, reducing the value of the property of their homes. You can imagine, in a couple of years' time, there'll be a, TV program with Kirsty Allsop showing how to, make your home less valuable.
Exactly.
Well, Lawrence Llewellyn-Bowen has painted a massive picture of Keir Starmer on your on the front of your house. Now it's worthless.
Yeah, 1.7 maximum.
But that's the problem with doing all these little things. Whereas actually, if you tax income, most of us, don't have an option but to have an income. So it's actually an effective way of raising it. So I think this is going to be a perpetual problem. It may well be that the numbers look good tomorrow in the first instance, and bond yields fall. But I think digesting it afterwards might be a bit more challenging.
That's it. The first move tomorrow isn't really going to be that important, is it? It's going to be the next 24 to 48 hours.
I think so. I mean, you look at the market reaction to the budget last year, and actually, Reeves's announcements, because she'll come out with the deficit numbers before she's announced all the tax changes and spending changes to do it. And actually, the last year the announcement was pretty strong. The deficit was going to fall by a percentage point, and markets like that. And then actually, I think it was a miscommunication on the part of the OBR that described that as the most expansionary budget ever, which it really wasn't, that then sent bond markets in the other direction. So I think it takes a bit of time for everyone to settle. And once again, if bond yields go up, lots of people run around saying, oh, this is the Liz Truss moment, let's get a lettuce out. I'm not sure it will be a Liz Truss moment, because I think conditions in the economy and in markets are very different to the conditions in the autumn of 2022 when we had a very expansionary budget that was genuinely expansionary, and I think that rather than debt was the problem then, and I think that's the deficit is still the big issue for the government today.
But what do you think about the actual structure then? The way that the OBR plays such a big part in it?
I think, it's really interesting. If you look back over the last 40, 50 years, when you've had a serious change of government, in 1979 when Margaret Thatcher came in 1997 when Tony Blair came in 2010 when Cameron and Osborne came in, each of those occasions, the government came in and said, the previous macroeconomic policy framework, often how you set interest rates, how you run fiscal policy, was completely rubbish. It's been a disaster. We're going to review it and make some big changes. And one of the many missed opportunities I think this government have had is that they've not done that. They've just carried on with the previous framework, stuck with more or less the same fiscal rules. And actually, the OBR is a fairly new institution. It's only been around for 15 years, and it's worthwhile asking ourselves, has the creation of the OBR and the fiscal policy framework around it made fiscal policy better or worse than it was before? In much the same way as you could say, did Gordon Brown making the Bank of England independent in 1997, did that make monetary policy better or worse than it was? And I think you'd have to be pretty stingy to say it was worse. It's worse now than it was in, say, the 90s. Whereas with fiscal policy, what I think the OBR has done has made governments much more tactical in terms of how they manage the OBR forecast, rather than strategic in how they're going to implement a process of budget consolidation over 3 to 4 to 5 years. It's all about getting the right amount of headroom, the right forecasts, rather than doing what's right. And what's really interesting is it means you get situations like we've had over the past month, where the government's just floating ideas, seeing how they work, and then the OBR presses F9 on the spreadsheet, and it's like, oh, you've got a bit more headroom, great, we'll drop the income tax, and it's like, that's no way to run a G7 finance ministry. And ultimately, it hasn't worked, right? When the OBR started, the whole point of it was to stop government debt from going through the roof. When it began, government debt to GDP was 75%. It's now over 100, and the deficit's 5% of GDP. So it's quite hard to say this has been an enormous benefit. It's quite fun for the opposition because it does put governments in a tight spot, but does it make economic policy making at the heart of government better? I think, people might disagree, but I think the answer is definitely no.
Because monetary policy, we can't even get the Bank of England and the forecasters getting inflation right in 6 months' time. Never mind the fiscal. In 5 years, how is the fiscal picture going to look? So is it just a guessing game, but it's the best guessing game we've got?
Yeah, I think, I'm an economic forecaster who's got lots of forecasts wrong, as you well know. And actually, that's part of the gig, right? Stuff happens that you didn't expect. And actually, the information often in the forecast is where and how you got it wrong. Lots of your trading colleagues may disagree with me at that point. But ultimately, having the government own its own forecast, at least then, when a pre-George Osborne government put out a fiscal forecast, those of us, in the city as economists, we can look at it and go, well, that's just complete garbage. That's never going to happen. So there was already, and we go and tell our bond traders that. So there was already a mechanism of the government having to present something at least half credible. So, I think part of the problem is that you've now got someone else making those forecasts, which are wrong because they always are going to be wrong. But it makes it harder for the government. And once again, things like, this productivity downgrade that the OBR have done that's increased the size of the black hole. That came more or less out of the blue. If that had happened 3 years ago, that would have affected how the Conservative government acted, but they didn't have to. If it had happened a year ago, ahead of the last budget, actually it would have allowed Chancellor Reeves to go, look, this is the mess I've inherited. We do need to make some tougher decisions, but it's sort of come at a completely random time. And actually, once again, having the government in charge of that, and a bit like a new CEO coming in, let's kitchen sink everything. And in 2024, the Labour government comes in and goes, those productivity forecasts are clearly over optimistic. Let's downgrade them so that we can hopefully beat those forecasts in 3 or 4 years' time and have some tax revenues to hand back to the electorate at that point, you know, that's probably a better way of doing it.
And we've had the debacle with the income tax forecast, and then the various measures that have been leaked so far. How much fiscal headroom do you think she has to end up with to be comfortable with?
I think she needs at least 15 to 20 billion.
Right.
But I also think the timing here really matters, because once again, so many governments have met the OBR's fiscal rules, which are all where you're going to end up in 5 years' time. Those forecasts that are completely rubbish.
Yeah.
Whereas actually, you know, what I think the bond market and what people are going to want to see is, you know, meat on the table. You've got to take the political pain now. So, yeah, where are your spending cuts? Where are your tax increases? How does that get the deficit down next year rather than in 2 or 3 or 4 years' time? So I think ultimately the size and timing of the deficit reduction matters far, far more than how much headroom is left at the end of the fiscal forecast, because that number will be wrong anyway. We can know that for certain in a way that actually, you know, if they've got significant credible and effective tax increases, credible and effective spending cuts, then actually the budget forecast for next year should be more credible than the one we had for this year, which, you know, is out by over 1.5 percentage points of GDP, which, you know, is a pretty good miss.
So if she's no income tax, no VAT, no national insurance changes, you've got the little wealth tax there. What are you left with? No bank tax?
No, well, you're left really with the hope of fiscal drag. You know, this idea that you freeze the income tax and national insurance thresholds, which once again works cumulatively. But yeah, it's once again, that's the problem I think markets are going to have to digest, is that there are likely to be a whole range of very small tax increases here and there. And how credible are those? You know, are they cumulatively and individually in a way that, once again, 1 or 2p on income tax, you kind of know what the effect's going to be, whereas, you know, these small measures potentially, you know, may not work. So I think there's a whole issue with credibility there, that, you know, the policies they seem to be pursuing are pretty limited. I mean, you know, whether they make some harder choices on spending cuts. I mean, for me, you know, one of the big problems, you know, all governments in Europe have to deal with, not just the UK, is, you know, we're dealing with an aging population. We still have the triple lock, you know, which provides, you know, really great income growth for people over the age of 65, 67, who generally don't work. So you're funneling loads of money into the unproductive part of the economy, no offense, but, you know, and also you're providing huge amounts of financial support through the NHS to keep that aging population healthy. And of course, you know, over time, the tax burden that the working age population is going to have to bear to finance that is going to go up and up and up. And, you know, one of the things that governments of the past should have grasped and failed to and still fail to is just dealing with the retirement age. I mean, you know, as you can probably guess, you know, I'm not getting any younger, but the idea that I'm going to be stopping working in 10 or 15 years' time doesn't necessarily feel quite right to me. And so, you know, I think we're all living longer, so we can all work longer. And it's a high quality problem. But ultimately, those are the big structural things that governments need to get to grips with, rather than, you know, tweaking the tax, you know, small taxes over a 1 to 2 year horizon.
Do you think there could be something left field like that hasn't been mentioned?
I think it's difficult, because once again, you know, measures like that are deeply unpopular. I mean, if Reeves was to say we're going to change the triple lock to, you know, just make it indexed to earnings or inflation or something like that, you know, then there's going to be a load of MPs up in arms, as we saw with the rental fuel allowance. So, I mean, actually, I mean, I thought the idea that, you know, you did the sort of 2 for 2, where you raise income tax by 2 percentage points and you cut employee national insurance by 2 percentage points, was actually, yeah, it broke the letter of the manifesto, but it kept the spirit, which is we're not going to raise taxes on working people. But, you know, if you've got a really nice chunky pension income, you're going to pay a bit more tax because you don't pay national insurance. So actually, from an intergeneration, it was quite a smart way of doing it. And once again, you know, politically, old people don't vote Labour. So, get with the programme, guys. I mean, exactly, George Osborne completely shafted young people because they didn't vote Conservative and funneled all their income and their support to older people. And actually, that shored up a very solid electoral support for the Conservatives. And, Labour need to start, and I think that's one of the issues with the Labour government in general. There's no sense of strategy that, whether that's political or economic, that a budget is designed to forward and further.
Talking about lack of strategy, I feel we've covered the fiscal element. Now, I've got to be careful because I'm in the Bank of England on Thursday afternoon. But where are we with QT at the moment? Isn't, the problems in this country are growth, and we're really struggling to get that going. So why are we still doing QT?
I've absolutely no idea. I mean, I've been quoted in the FT as describing it as bonkers, and I think it is. I think QE and QT are exceptional policies for exceptional circumstances. Yeah, absolutely. But I mean, QE was designed for a world in which central bank had got to zero interest rates or thereabouts, and you needed to do something else to stimulate the economy. So buying government debt and effectively transforming 4-5% yielding government debt into 0% coupon reserves is a really nifty fiscal trick to allow further headroom for fiscal policy to stimulate the economy. And people can disagree on quite how QE works, but that was kind of the point. So you want to do QE when you're worried you're going to undershoot your inflation target a lot and you've got no room left to cut rates. So QT should be exactly the opposite. If you're in a world where inflation has gone sky high, where you're really trying to mop up money in the economy by selling government bonds, that makes a huge amount of sense. And actually in 2021, 2022, when inflation was in double digits, there was a case for doing that. But now, when actually the Bank of England are cutting rates, selling, a huge number of government bonds is, I think, not just unnecessary, but very dangerous for the Bank of England because, in my view, it's not the level of debt, it's not the stock of debt that really matters, despite the fact people end up talking about it all the time. Yeah. It's the flow, it's the issuance of debt, i.e. the deficit, the amount the government has to borrow and issue new government bonds every year. And of course, the Bank of England is part of that. So, the government, as I say, is borrowing 5% of GDP a year in new government bond issuance into the market. The Bank of England is supplementing that with another 2 to 3 percentage points of GDP itself. So the British state is basically asking the market for 8% of GDP worth of borrowing a year. And so, the Bank of England is making the government's already really difficult job even harder. And I think there's a genuine danger that it endangers the Bank of England's independence, which, as I say, historically, I think has been a good thing. Because if there is a bond market puke at some point, to put it bluntly, in the next few months, which might be because of the British government, it might be because Donald Trump's tariffs are rescinded by the Supreme Court, and suddenly there's a huge fiscal stimulus effectively in the US. Bond markets fall out of bed, and the British government has a choice between... The market basically says to the British government, we can't digest these bonds. So your choice is cut spending massively, increase taxes massively, or tell the Bank of England to stop selling those sodding bonds. And quite frankly, the right thing to do is to tell the Bank of England to stop selling them. And at that point, the Bank of England's independence will be perceived by markets as going. So it's like, don't do stupid things that will cause, it's like sort of raising a kid, isn't it? It's like, don't do stupid things that are going to cause me to tell you off. And actually, that's what I think the Bank of England are doing. I think it's a serious mistake. And if inflation was in double digits, I'd say, great, this is a really sensible thing to do. But it's not, it's 3%.
I'll be sure to pass those feelings on Thursday afternoon.
I suspect that's probably why I've not been invited.
Well, we have to touch on climate change then, because the people that are watching, that are hearing your area of expertise now and what you've moved into, what do you think the risks are? Putting the to side the ESG and that kind of thing. What are the real risks in the next 5 to 10 years?
I think they are climate change itself, and I think the discussion over ESG in banks, in companies over the last 5 or 10 years, it's all been about getting a sustainability report, nice picture of a turtle on the front, and bang, you're done. Hey, we've got a net zero for 2035, happy days. And I think actually, that's still a really good and important thing to do. But the problem is, you know, you as a person, you as a company, you as a country can get to net zero in 5 or 10 years. But if the rest of the world doesn't, then we've still got the big problem of climate change to come. And I think, you know, one of the really interesting areas of economics at the moment is, you know, people working on the economics of climate change and the economic impact of it. Because, you know, what we tend to forget is that climate change will affect everyone because everyone's climate will change. And, you know, how we dress, how we go to work, how we live is entirely a function of, you know, in London, of our climate that London's had for the last 200 years.
Yeah.
That's going to change significantly. So all the sewerage, all the buildings, all the heating in the buildings are all designed for, you know, London in the 1950s, 1990s, early 2000s. The world we'll go into is where, you know, one where obviously it'll be warmer, but weather will be more volatile. So we'll get more extreme weather, more heavy rainfall, more real scorching hot days where the temperature goes above 35, and where if you haven't got AC and you're flat in London, you know, you're going to get really unpleasantly hot, and it's going to affect your health. It's going to affect your productivity. And I think, you know, that is inevitable. And clearly some places in the world, particularly in emerging economies and in frontier economies, are really going to suffer over the next few years. I mean, the GDP of cumulative effects of climate change on economies as a whole, you know, is likely to get up to sort of 5 to 10% of GDP by, you know, mid to late this century. And obviously that'll be cumulative and it won't be distributed evenly. So some countries are going to be affected more than others. Some places within each country are going to be affected more than others, and some sectors and businesses are going to be affected more than others. So I think there's an enormous benefit to companies and firms really starting to think hard about how their businesses, how their factories, how their supply chains are going to be influenced and impacted by climate change. And there's an enormous amount of really interesting work. I mean, it sounds like, you know, a trader's idea from hell. You know, what happens if you cross a weather forecast with an economic forecast? But actually, you know, the climate models do give you a good sense of where, you know, the sort of meteorological risks for a certain area will come. You know, will London have more flash flooding in the 2050s? Yes or no?
Will Scotland become the top tourist destination in the world?
Oh yeah, you know, lovely sandy beaches, warm. Exactly. But you know, that's the sort of stuff that can happen. And you know, actually, you look at the sort of the further north you go, generally, you know, the economics suggests that climate change could actually be positive for those sort of areas. So, and once again, there will be industries and sectors that benefit, but net there are going to be more than lose out. So it's about almost, you know, thinking about how businesses can get prepared and adapt. Because if you invest in adaptation early, it's likely that climate change is going to cost you a lot less in the long run. And unfortunately, we're going to have to live with that.
Are there any obvious investments for the long term, you know, or trades as we used to call them, you know, that jump out to you?
I think, you know, sort of anything to do with climate adaptation. So I think, you know, companies that can help fix parts of our infrastructure. So, you know, not so Thames Water, but, you know, the companies that will help improve and manage, you know, the flow of sewage and water during flash flooding. Those are the sort of businesses where, you know, companies and governments are going to have to spend more on. I mean, you know, very simply, you know, air conditioning installers and things like that in places like the UK are going to do very well in the next 20 years because most of our housing stock is not designed for extreme heat. We're not going to, it's not going to become like Dubai or anything like that. But on some days it will be like Dubai, except we won't have the infrastructure and air conditioning to be able to live like Dubai. And so it's businesses that can enable, you know, our physical infrastructure, our corporate infrastructure to be able to cope with that, that I think are going to do very well and be in high demand.
Fantastic. Neville, thank you very much.
Thanks for having me on.
Time has hit us. So do have a look at it. So Andrew McKelvey's saying problem with pensions is people start work much later because of universities. So they're not paying tax till they're 21, 22, 23. Do you just add 5 years at the other end then?
Well, I think ultimately you really want to keep people working until, not until they drop, but you know, you want to. I think, you know, generally keeping people working is, as long as you're not sort of working insane hours, but you know, it's pretty good for your health, your mental and physical health. And I think, you know, people should be able to work and encouraged to work for as long as they're capable of it. And clearly you don't want people who are, you know, getting old and decrepit to be forced into work by, you know, the kind of job centre or whatever. But, you know, I think there's a fine balance, and we're some way from that point. So yeah, I think, you know, we probably do want to extend our working lives. And I think, you know, part of the trick is to make sure that work as you get towards the end of your working life is still fulfilling and rewarding and enjoyable and social.
And on that note, with you know, 100 people sitting at home watching this and trading and, you know, living the good life as we are in here, then you know, great note to finish on. Thank you very much for coming in. Great to see you again. And yeah, we'll see what happens tomorrow. So join us tomorrow morning. We've got, of course, we're going to talk budget in the morning. Piers is going to be with us as well. But then at 1 p.m. we've got the budget special live reaction with myself, Chris Beecham, and Axel Rudolph. We'll see you tomorrow. Have a great day. Good luck this afternoon in these tech stocks in the US.